In financial reporting, the fair value principle states that the position should be reported on an ongoing basis at their fair market value, the price at which a position can be sold if an asset, or the price at which it can be settled if it is a liability. If you want the accounting standards for the fair value definition, then they are in US GAAP ASC 820 and IFRS 13. The opposite of fair value accounting could be historical cost accounting, which states that assets and liabilities should be recorded at their original cost, so the price paid if an asset, or the price agreed if it is a liability, when the transaction was first undertaken. The fair value approach has come in for some criticism over the years, including the Wall Street crash of 1929 and 2008 global financial crisis, and maybe even the recent Silicon Valley Bank collapse. In fact, the fair value approach was suspended by US Securities and Exchange Commission, so SEC, between the 1930s through the 1970s. I won't go into the details of these discussions, but if you search on free articles from Harvard Business Review, there were two I would recommend reading. One is it fair to blame fair value accounting for the financial crisis? And the second one is why fair value is the rule. It's completely free and there are a lot of discussions on this topic. But overall, despite the criticism, there are a lot of benefits of fair value accounting that outweigh its challenges because the mark-to-market or fair value that are regularly updated and produce reports that are indicative of economic events and therefore makes it difficult to engage in trading manipulation. But let's move on. Generally speaking, there are two approaches for fair value. One is mark-to-market, and here the best evidence of fair value is quoted prices in an active market. If no active market or no quoted prices available, then we use the second approach, which is mark to model. Here, a valuation technique is applied. The objective of using a valuation technique is to estimate the price to sell an asset or transfer a liability. But remember, the accounting standard says fair value is not based on forced transactions, involuntary liquidations, or distressed sales. It's in an orderly transaction between market participants at the measurement date. Here is a typical table if you research fair value hierarchy. We have level 1, level 2, and level 3. And the key here is the leveling is based on price observability. Level 1 is based on quoted prices for identical instruments in active markets. For example, quoted share price of a Vodafone on the London Stock Exchange. Level 2 is quoted prices for similar instruments in an active market or for identical or similar instruments in markets that are not active. If it is a model valuation, then all significant inputs are observable in active markets. For example, interest rates and yield curves observable at commonly quoted intervals. Another example is implied volatilities and credit spreads. These are all level 2 examples. If it is not a level 1 or level 2, then it is level 3. This is unobservable input, for example, correlation in a first to default note or volatility in an equity-linked note. So in summary, level 1 is the least risky hierarchy with the most liquidity and reliable fair value measure. On the other hand, level 3 is the riskiest hierarchy with the least liquidity and has a great deal of assumptions and estimates to arrive at fair value. Thanks for watching, and I will see you in the next session.